Hello and welcome to the Business Standard Morning Show. I'm Binu Sandhu. It's the 2nd of January 2024 and here are the questions we will be answering today. Will deal reversals continue for Indian IT in 2024? What will 2024 hold in store for OTTs? Is India Volatility Index hinting at a downturn ahead? And what is XPoSat? Mirroring global trends, the Indian IT industry showed muted growth in 2023. The slowdown, which set in somewhere in the middle of 2022, continues to haunt the sector. Offshore deals are being called off and hiring has shrunk for the first time in the last 25 years. But experts see a silver lining as the global economy is recovering. So will the Indian IT industry continue to face a ramp down in deals in 2024? Ayush Mishra brings you the answer.
Infosys on 26th of December revealed about the termination of a $1.5 billion deal with a global client. Focused on artificial intelligence solutions, this deal with the unnamed global company was announced in September last year. Tata Consultancy Services, or TCS, also lost a significant IT outsourcing client as Transamerica Life Insurance terminated the remaining portion of a 10-year, $2 billion contract initiated in January 2018. Transamerica cited challenges in the macro environment as the reason for cancelling the contract. The agreement signed in early 2018 had TCS collaborating with US-based Transamerica to digitize over 10 million policies into a unified integrated platform. These two deal cancellations may not be enough to establish a trend, but they could perhaps become a cause for concern. Industry experts suggest that clients of leading IT services firms are pushing for pre-inflationary rates and pricing concessions in both new agreements and contract renewals. This demand for more favorable terms could be a contributing factor to the cancellation of deals.
This is more to do with, this is more of a global phenomenon around how technology is evolving. If you look at deals traditionally, those would be 10-year deals. And it was fine to have a 10-year deal because change in technology or how technology would evolve would not be so fast. But now as we see technology evolving at the pace and the rate at which it is, we are seeing new and new things like AI, blockchain, all of it coming in. It probably becomes difficult to hold it into a contract which is of a duration of 10 years. So we are seeing this as a trend globally, not with any specific company as such, that contracts are becoming shorter or clients are more and more prone to cut short contracts so that they can bring in more versatility in technology and the contracts can look at the evolving nature of technology.
The reason for the cancellation of the deals was not disclosed by the companies. The cancellations also highlight change in technology and the uncertain economic condition in the global economy, which has impacted the IT sector's performance. Amid concerns over inflation and a looming recession, the $245 billion Indian IT sector is grappling with challenging conditions as clients are cutting spending on non-essential projects. Industry leaders, including Tata Consultancy Services, Infosys and HCL Tech, have been compelled to accept contract conditions such as guaranteeing minimum cost savings, billing the client only if certain goals are achieved, and reviewing cost overruns. According to IT research firm Everest Group, over 80% of the 1,600 IT and business process management deals tracked in 2023 featured committed savings clauses compared to approximately 65% in 2019. Deals signed this year with such clauses reportedly include HCL Tech's $2.1 billion agreement with Verizon and $454 million deal between Infosys and Danske Bank.
At this point in time, the IT sector is facing a lot of uncertainties, and these uncertainties has never been new to the IT sector. It has always been, technology has always been challenging from that perspective, that it has gone through constant change. Now, you have seen that the latest is the generative AI, which is introducing some sort of disruptions at this point in time. It can be an opportunity, it can be a threat for some, depending on how you take it. There are other uncertainties also related to the growth and many other factors which are actually impacting the decision-making process of the clients. But as I see, 2024 appears to be good for IT sector, and we expect that double-digit growth in the IT services spending is going to continue in 2024.
Major Indian IT services firms are placing strategic bets on substantial and mega deals to enhance their client focus, resulting in increased revenue, accelerated growth, and long-term cost savings. These companies typically define deals with a value of $100 million or more as large, while those reaching or exceeding $500 million are classified as mega deals. TCS won $11.2 billion in deals in Q2 FY24, which is a 38.3% increase compared to the last year. This includes the two large deals from BSNL and Jaguar Land Rover. Infosys saw an increase in total contract values by 180% in the September quarter by winning deals worth $7.7 billion. HCL Tech also reported record high deal wins worth $3.97 billion, which is a 65% year-on-year increase. In FY24, reports indicate that the combined total contract value for the top 5 Indian companies, which are TCS, Infosys, HCL Tech, Wipro and Tech Mahindra, is expected to range between $70 billion and $85 billion. Renewals are anticipated to constitute around 30 to 35% of the overall deals secured. So what could be the future course of action for these companies?
They need to actually constantly renovate and innovate, and that is the way forward for the organization. They need to look at closely watch the trends which are there, leverage the kind of situation which is unfolding in front of them, and they have to be agile and flexible in order to navigate through this crisis which we often see in the market. There are a lot of opportunities also coming up, and from that perspective, I see that the demand for sustainability is growing, and the companies need to be more aggressive in terms of driving sustainability.
It is too early to establish a trend based on the recent cancellations. Meanwhile, there is optimism among experts regarding the dual advantages that AI could bring to the IT sector: increased deals and reduced costs through the potential replacement of engineers. To conclude, the specific deal cancellations of Infosys and TCS are more likely to be isolated setbacks, but tougher deal negotiations are likely to continue in 2024.
OTT platforms, meanwhile, continued to entertain viewers in 2023. An SPI report in August last year said that OTT platforms would soon dethrone multiplexes as India's go-to entertainment option. So what is in store for OTTs this year? Shivam Tyagi finds out.
Indians love binge watching. They are devoting a considerable amount of time streaming their favorite TV shows and movies on OTT platforms. While the country's OTT market is growing at a compound annual growth rate of 36%, a report by Eros Now and KPMG indicates that an OTT consumer in India streams for an average 70 minutes a day and 12.5 times a week. According to a report by Omax Media, the OTT streaming applications have now reached 34% of India's population. The total audience on the platforms grew by 13.5% to reach 481 million in 2023, from 423 million in 2022. The report indicates that the OTT universe is rapidly growing owing to its adoption outside the big cities. India has over 36 million individuals who pay for one or more streaming services, while 77 million people stream their favorite shows on subscriptions taken by their family or friends. The majority of users, however, still consume free streaming content, including YouTube and other social media platforms. The major players like Disney Plus Hotstar, Amazon Prime, Sony Live, ZEE5 and Netflix command the major share in the Indian market. Apart from national players, several regional OTT players are also emerging in the Indian market. Platforms such as Hoichoi, Sun NXT, AHA, Kude and Stage are catering different cultures and regional languages.
Today you have an interesting mix where you have small regional players who are releasing one original piece of content every week through the year, right? That's more than 50 pieces of content a year. That's a lot of budget. But out of that, the tentpole may be less than 5, right? On the other hand, you have large platforms which buy big Bollywood and South films at big amounts because that drives subscription takeoff, that attracts customers to download their app and install it and register. So in my mind, tentpole content will do very well. Low-end content will do very well. It's the kind of in-between content that we are seeing, which is neither tentpole nor low cost, which really needs to prove its mettle. So I think you're going to see production budgets kind of get reallocated to what works best, what sustains best, and anything that doesn't work really is going to see a bit of pressure.
While the industry is growing, certain OTT players struggle to achieve profitability, prompting cost cuts measures. Platforms now opt for safer choices in acquiring new titles and reducing investments in premium shows. Industry experts caution against free access to premium content like cricket, which may adversely affect the overall revenue stream. This is primarily due to the substantial expense associated with media rights. Attempts to offset the decline in subscription income solely with advertising revenue have proven to be challenging for the streaming platforms. Industry players are also moving towards consolidation. Ongoing mergers like Sony Zee and Reliance Disney have been in the news for quite some time. But nearly 2 years after announcing a merger plan, Zee Entertainment Enterprises has asked Sony Pictures Networks India, now known as Culver Max Entertainment, to push back the deadline. Salman Waris of TechLegis Advocates and Solicitors explains, making the industry move towards consolidation.
Most of the OTT players are actually operating under heavy losses, and that would force some of the smaller players to be acquired by bigger players. Obviously, this year the growth has been a little less than the previous year, so between 12, a little higher than 12%, while earlier it was 20%. But still, in terms of the overall market penetration of OTT services, has just been about 34%. So we expect that to grow, and the growth in telecom sector as such generally in future is, as far as data is concerned, that's where the growth lies. So there's going to be more investment and more growth and more consolidation in the long run, and I think that would also bring in more government oversight and more regulation.
Content on OTT platforms and traditional television are not the same. TV content is regulated by the government, but for the millennials and Gen Z, OTT is now the new television, as it offers distinct treatment of content matching the standards of world cinema. OTT content is presently regulated by IT Rules 2021. Experts note that the grievance redressal mechanism outlined in the new IT rules is being misused by the self-regulatory bodies to moderate selective content. In response, the union government has now moved to regulate digital publishing services through a new bill. In 2023, the government proposed a draft broadcasting services regulation bill, essentially bringing in the OTT streaming platforms and digital news platforms under the ambit of traditional broadcasting regulations. So, how will the new bill change content on OTT platforms going forward?
I think there could be a certain influence on the content as well, because we have already seen, as far as the self-regulatory body is concerned, they have passed certain orders which have been controversial, where they have tried to play the content moderator role and highlighted two or rather issued orders to OTT players, and which almost are in the nature of as if they were orders of the court. So we think that that kind of an overlap or that outreach could continue under the broadcast bill as well, and there could be a certain level of hard or rather over regulation as far as the content moderation is concerned in terms of the powers under the broadcast services bill.
Some experts are hopeful about the new bill in the parliament, anticipating better clarity on the powers of self-regulatory bodies. However, they are also concerned about potential overregulation of content in 2024. What else is in store for OTT players in 2024?
On one side, we are hearing about a lot of consolidation in the market, right? Which brings together certain powerhouses of content that will really bring great quality content into the OTT world. On the other side, we are seeing a revenue model which is changing, right? There's a lot more free content that's being made available today. And how long that lasts, I mean, great for consumers. Let's see how long that lasts, from a market point of view. So you have two very different forces that are coming around. I think what we're going to see is a massification of OTT over the next 2 to 3 years, right? You're going to see more and more content now getting out of the top 20, 30 million homes and be created for the next 20, 30 million.
Cracking the Indian OTT market is not easy. Experts emphasize the need for a deeper understanding of sustained profitability. In the evolving landscape of the streaming industry, they believe New Year is going to be beneficial for both players and streamers as consolidation continues.
It is not just OTT media services. The march of Indian equities also continued last year. They gave stellar returns of up to 20% in 2023, and most of these gains came in November and December. This fast-paced rally has also sent the Indian Volatility Index to multi-month highs during this time. The rising gauge means markets expect high volatility ahead. So are equities ripe for a correction in the new month? Harshita Singh finds out in this report.
Equity markets have had a dream run in 2023 with sharp gains of up to 20%. However, as Dalal Street begins the month of January, the accelerating rally could face resistance as signaled by key indicators. The India VIX or Volatility Index, which measures expectations of short-term price fluctuations, has surged almost twice from lows 8% in November to a high of 16% on 28th December. A higher VIX reading signals distress and fear among traders. However, a rising VIX in a market bull run is unusual and thus hints at over-exuberance and risk seeping in, experts say.
Technical structure is that the VIX had reached the lowest level, closer to 8-9%, and from there it has started to advance and break out of that range. But at the same time, the Nifty has not fallen. So the VIX is essentially giving us a lead indication that maybe there is a trend reversal coming at hand. Yes, it is a sign that there is some degree of overheating in the market, because the Nifty the premiums basically are what is behind the reading in the VIX, right? If the premiums that people are paying for call options, put options start going up, then it shows that going into the month of January, there may be people buying an increasing amount of protection. Simply the premiums going up have a direct impact on the VIX going up. And therefore, apart from showing that there is risk perception, it's actually a sign of exuberance in the markets that is causing this divergence. But like I said, divergence where the VIX rises against the Nifty can be an early signal of a pending market correction.
As per Srivastava, Nifty futures premiums have also shot up, signaling overheating in the market as traders has paid higher premiums to roll over their long positions. As per IIFL research, at the end of the December F&O series, Nifty rollovers were higher at 80% versus the 3-month average of 77%, hinting at a long build-up. FPIs too are starting the January series being net long in index futures. Of their total index open interest, the long index futures OI is at 70%, which signals a precursor to market reversal. It adds. Thus, with valuations at a stretch, experts suggest investors increase their cash levels.
We now need to be rather mindful of the fact that the market may see some consolidation at the higher level or see some sharp profit taking bouts from the current level. So investors who are very anxious about the super profit which they have made this year, we would recommend to them to do some profit booking of nearly 15 to 20%, but also plug back that money again into the equity market in the stagger manner.
Historically too, January has been a seasonally weak month. In the last 10 years, it has given negative returns 7 times. Thus, it is prudent for investors to brace for a potentially downtrend ahead. Today, the last street will take cues from other Asian markets that will return to trading after the long weekend.
He's making plans for an early retirement. Business Standard.
Like the financial markets, India's space sector too has been scaling new heights. ISRO rang in the new year by launching the XPoSat mission. The aim is to study black holes and neutron stars. Kasturi Akhil has more on this interesting project.
The Indian Space Research Organisation, or ISRO, launched the country's first ever polarimetry satellite using a PSLV. India skyrocketed into the new year quite literally by launching its first X-ray polarimeter satellite on the 1st of January. The satellite, called XPoSat, will mark a crucial milestone for India's space journey, as this is not only India's first dedicated polarimetry mission, but also the world's second, following NASA's Imaging X-ray Polarimetry Explorer (IXPE) that was launched in 2021. The XPoSat will study the polarization of intense X-rays of the 50 brightest known astronomical sources in extreme conditions, including black hole X-ray binaries, non-thermal supernova remnants, neutron stars, active galactic nuclei, and pulsars. The satellite will be placed in a circular low Earth orbit of 500 to 700 km with a mission lifespan of at least 5 years. X-rays have high energy and short wavelengths, typically ranging from 0.03 to 3 nanometers, according to NASA. Some X-rays are incredibly small, even smaller than a single atom of various elements. So when an object is very hot, it emits radiation with shorter wavelengths, and X-rays are a result of this. Celestial objects that emit X-rays are extremely hot, often reaching temperatures in millions of degrees Celsius. Pulsars, galactic supernova remnants, and black holes are examples of such scorching celestial bodies. Developed by the Raman Research Institute in collaboration with U.R. Rao Satellite Center, formerly known as ISRO Satellite Center, it will help understand the emission mechanism from various astronomical sources, which arise from very complex physical processes that are otherwise hard to decode. Essentially, polarimetry studies the measurement of the degree of polarization of the radiation that is reflected from a surface. The polarimetry measurements will thus add 2 more dimensions, degree and angle of polarization, to the existing spectroscopic and timing data that will help understand the emission processes better. Both degree and angle of polarization will be measured by the primary scientific payload, POLIX, which is the first payload in the medium X-ray energy band dedicated for polarimetry measurements. While the second payload, called XPECT, will measure the spectroscopic dynamics related to absorption and emission of light of the astronomical sources. As per ISRO's website, a payload is the scientific or technological instrument carried on board a satellite for a specific purpose. They vary in their purpose, size, composition, capabilities, etc.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
Armed with 4 sophisticated X-ray telescopes, this satellite offers a unique window into the enigmatic realms of the black hole. Well, that's all for today. For more news and analysis, please log into our website business-standard.com. Thank you for watching.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.